My dear investors and friends, welcome to our monthly communication on markets and investing. So, what are we going to talk about today? We've just seen the conclusion of the second quarter earnings season, and the numbers are out. And it would be interesting to see how the corporate sector and the broader markets have performed in general. And the story is very, very clear. If you look at the top 500 companies in India, in the quarter ending September 22, we had a very strong revenue growth of almost 29%, but we had a 3.5% contraction in profit after tax, and that was largely to do with compression in EBITDA margins because of higher commodity prices. And if you remember, we saw the same trend in the first quarter, which got carried over to the second quarter. However, if you take the financials out, because as you all know that margins for banks actually went up. So if you take out the 70, 80 odd financials out of the top 500 companies, and if you look at the 420 companies, ex financials, this trend is even more clear. Ex banks and financials, we had almost a 32% revenue growth year on year. But we had almost a 5 percentage points downtick in EBITDA margins on a year on year basis and 120 basis point even lower than the first quarter. And as a result of that, the PAT of these 420 companies actually fell by 26% on a year-on-year basis. So, what should we take away from this? A, the strong revenue growth denotes two things. One is that demand is still pretty strong. Yes, to some extent the revenue growth is also higher because of inflation, as many companies have taken a price hike. But the fall in profits tell you that there continues to be a pressure on margins, especially for the manufacturing companies. And therefore, the uninterrupted earnings growth cycle that we saw post-COVID, in the first half of this year, the trend in profitability has reversed. And therefore, if you really look at what's happening in the markets, is that while Nifty is at a new high, the broader markets have struggled. And that has largely to do with the fact that we have seen an impact on profitability in the first half of the year. So how should we think about what is likely to be going forward? If you look at the cumulative impact on Nifty earnings as a result of the first half softer margins, is that we've roughly seen a cut of 6% in the earnings estimate of Nifty companies after continuously 7 quarterly cycles of upgrade. So you can think of it like an intermission in a movie, right? रुकावट के लिए खेद है. However, our belief is that commodity prices have started to soften. We believe that some of the margins that have been lost should come back in the third quarter and the fourth quarter. And therefore, the performance of the broader market beyond the current narrow movement in the market will really depend on how companies are able to pass on the higher raw material, people and commodity costs onto consumers. If we see that happening in the third quarter, and we think that there is a very high probability that in the second half of this year, at least some of the margins that have been lost will come back, as there is always a time lag between raising prices and getting the full impact of that in your numbers. Despite the current challenges, if you look at the trend of the last 4 rolling quarters for the Nifty, as you will see in the graph, earnings are still rising, but at a slightly slower rate. And as we speak at the end of the first half of this financial year, your Nifty earnings are very close to 796, and that puts the valuation of the market at a 23 times trailing earnings. However, as I said, we think this is a transitory phenomena. We do believe that margins should come back in the third and largely in the fourth quarter. And therefore, if you still look at 2 years ahead, current Nifty estimates bake in a 19% earnings growth next year, which is 23-24, and another 16% on top of that in 24-25. So if you look at a 2-year CAGR and if you look forward, we are still looking at a healthy 16 to 17% mid-teen earnings growth for the market. And therefore, we believe that the markets are still attractive. Earnings growth is still healthy double digits, but the first half has clearly got impacted. If you look at the global commodity index trend, it has already started to correct. And we can see that in the softening of inflation data. And if this were to persist, barring any incremental shocks, which we believe may not necessarily happen, it will also reduce the pressure on global central banks to keep hiking at an accelerated rate. I think it would be fair to say that inflation has peaked and that the interest rate cycle should also peak sometime in the first half of next year. Now let's come to what parts of the markets have done really well. So what we did was that on a 6-month and a 12-month basis, we looked at the top 10 performers amongst the BSE 500, which is our most used benchmark. And what you will see is that both on 6 and 12 months, the kind of stocks that have given stellar returns are either public sector units, largely in defense, energy, and material sectors, or some of the Adani Group stocks. Now, as you all know, that our investment style has been that we typically tend not to invest in PSUs, and we also do not invest in companies which have very high leverage. But if you look at the names, companies like Mazgaon Dock, Rail Vikas Nigam, Cochin Shipyard, Adani Enterprises, Adani Total Gas, Bharat Dynamics, you will see that across PSUs and Adanis and maybe some private companies are the ones that have driven stock market returns. And obviously, if we were to ask a question to ourselves, given the kind of performance that some of these sectors and companies have shown, what is our view on them? Let me first come to the Adani Group and the stocks. As you all know, more or less all the listed companies from the group have delivered stellar returns, and they continue to increase their weight in the various indices, which has posed a significant challenge to active investors who do not have exposure to these companies. So the question really is, why not? And if you look at the chart, you will see that almost all Adani Group companies, except probably Ambuja and Adani Wilmar, are in asset-heavy sectors. They have very high levels of leverage. They have seen a very rapid expansion and acquisitions. Now, usually, we tend not to invest in companies which are very asset-heavy, or especially when they have very high levels of leverage. The group as a whole today has leverage in excess of 2 lakh crores. And if you look at the table, there is almost $2.5 billion of foreign denominated bonds or borrowings across 4 or 5 of their companies which are coming up for maturity. If the group is able to raise equity and deleverage the balance sheet, probably that could make the case to even consider looking at potentially investing in some of the companies that have deleveraged. Obviously, we will have to look at the attractiveness of the business, the return profile, and so on and so forth. But as you clearly know, that very high leverage is a complete no-no as far as we are concerned. So unless we see very clear signs of deleveraging, it would be very difficult for us to consider any of the companies for potential investments. As you all know, that for many years we had no investments in Reliance, but we only considered Reliance for investment once they raised large amounts of equity during the COVID period from marquee global investors and substantially deleveraged the balance sheet. So I wanted to make this communication very clear as to the reason why we are not participating in a set of companies that have massively outperformed the benchmarks. The second cohort is public sector banks. As you all know, that post the COVID provisioning and after having raised capital, the credit costs or NPA of public sector banks, like their brothers in the private sector, has also reduced considerably. The asset quality has improved, and ROEs, which were usually very, very low compared to private sector banks, have also started to inch up. Having said that, we have participated by investing in some high quality private sector banks and NBFCs, which have also shown similar characteristics. But given the extremely deep valuation that we've seen in public sector banks, some of them have actually outperformed their private sector counterparts. Looking at the first 2 quarters of numbers and some of the recent reforms that the government has done in terms of allowing extended tenures for CEOs and managing directors of public sector banks, there could be a case to selectively participate in this cohort. And therefore, incrementally, we could potentially look at selectively investing in some promising names. The third, as I mentioned, area within the public sector is defense companies. Many defense companies have done phenomenally well. There is a lot changing at a macro level. There is increased focus on indigenization. There are almost 411 items that are now banned from imports and have to necessarily be sourced within India. And we think that the new orders being rolled out in missiles, in radars, in electronic systems and warfare, these orders should bulge over the next 3 to 4 years. and are likely to move from the development phase to the production phase over the next couple of years, benefiting the revenue and profitability of these companies. There is also a renewed thrust on exports, and the government has set a $5 billion exports of defense equipments since 2025. While we have indirectly participated in this opportunity by investing in some engineering and auto component companies who also supply into defense, I think given the positive cues and policies, this is an area that we would certainly look for opportunities, because if indeed there is seriousness in terms of developing domestic indigenous manufacturing capabilities, this could certainly be a long-term trend. And therefore, in our actively managed strategies, we would look to participate in some of these opportunities. Interestingly, our algo-driven PMS strategy, Alchemy Ascent, has very smartly allocated in many of the companies that I talked about. And one way to participate would be to invest in an unbiased, unconstrained investment strategy like Alchemy Ascent. However, on the active side, in high growth, select, and some of our other AIF strategies, we will consider some of these opportunities selectively. And on the Adani Group, as I mentioned earlier, we would only consider if the group takes very concrete actions to deleverage, but they will also have to satisfy a lot of other factors that are part of our evaluation framework. I think it was important to give this perspective because we have seen that while Nifty has made new highs, portfolios have not yet reached new highs because, as I mentioned, we had margin impact on several sectors, but that should hopefully reverse in the second half of the year. And there are sectors where we have very little or no exposure for the reasons that I just mentioned, some of which we may take a serious look, but some, despite the great performance, we shall avoid as they do not fit into our investment framework and philosophy. With this, I conclude this month's communication. Stay safe, stay healthy. Until next time. Thank you.